This is an attempt to describe the bank's balance sheet and the underlying reserves. On the assets side are loans taken out by people, companies, municipal and states. On the liability side are deposits made by customers. Deposits are seen as liabilities since the bank owes this money to the customers. The bank also have reserves at the central bank. Cash in the bank's vault are also included in the bank's reserves at the central bank. Even though they physically at the bank, the cash are seen as central bank money too. Bank reserves are banks' holdings of deposits in accounts with their central bank, for instance the European Central Bank or the Federal Reserve, in the latter case called federal funds, plus currency that is physically held in bank vaults, vault cash. The central bank sets minimum reserve requirements. The most common misconception is that banks make loans out of their customers' deposits. The story goes something like this. Let's say Peter takes a $1,000 loan from the bank. This will increase the assets on the bank's balance sheet with $1,000. He then buys a computer from Paul. Paul will get the money and put it on his deposit at the bank. The bank's liabilities will be increased with $1,000. The $1,000 are split, and 1/10, that will say $100, will go to the bank's reserve. And the bank will lend out 9/10, that will say $900, to, say John. John then buys a computer from William. William will get the money and put it on his deposit at the bank. The bank's liabilities will then increase with $900. The process is then said to continue, forming a geometrical series, creating about 10 times the initial deposit. But that is not the way new credit are created. This gives the impression that the bank makes new loans out of customers' deposits. It's probably close to the intuitive feeling people generally hold that banks lend existing money that customers put on their deposits. So this view is probably close to the way banks want you to perceive the process. But the way banks create money, or more accurately credit, from thin air is far more simple. Their asset side simultaneously as they expand the liability side, and it's all based on how large their bank reserves are. We will go into more details about this later, but the important thing to know is that the credit expansion always occurs simultaneously at both sides of the balance sheet, and are always equal. A loan is never based on a depositor's money, the credit is instead created when you request it. This means that, when you take a loan for your house, you receive a new credit that instantly is balanced by corresponding amounts of new savings. This means that all savings equals loans. The notion that savings are low is completely impossible. Savings are always the same size as loans within the laws of accounting. A deposit you have on your bank is not an asset, it is a claim on your bank. The bank never in short term has possibility of paying more than a fraction of its depositors back. This is why bank runs are so feared. The only way for a depositor to receive full payment on your claim on the bank is to withdraw physical cash. The fact that money is created when it is borrowed also means that it disappears when it is repaid. This explains the fluctuations in money supply, and why the money supply always seems to decrease in a credit crunch and increase in expansionary economy. We will also go into more details about this later.